Welcome back. So this is the part 2 of the AF3111 Intermediate Accounting 2 Week 9 topic, Fair Value Measurements and Globalization. And just before the break, we've looked at the basics of the fair value measurements, as well as we look at a way how to determine the principal and most advantageous market. And we're going to move on and look at highest and best use and some valuations approaches, as well as 3-level inputs in this part. Okay, let's go back to slide number 9 then. There you go. We are now on slide number 9 when we are going to look at some specific applications of Hong Kong FRS 13 fair value measurements on non-financial assets. What are the elements of non-financial asset then? Well, they would be like PPE, IP, and even inventories or intangible assets. Now, for those items, the measurements takes into account the ability of market participants to generate economic benefits by using the asset in its highest and best use, amount a number of alternative ways in which it can sell or use the assets. And this so-called highest and best use is determined from the perspective of the market participants, even if an entity intends a different uses. All right, right. And this requirement here apply to non-financial assets, unlike liabilities and financial assets, because they can be used within several different models, such as they could be used for own use, or could be leased to others, or can be sold as well. And where a non-financial asset is held for own use, it may on its own have little value, but when it considered together with other assets, it may have significant value. And IASB, or if you like Hong Kong ICPA, have considered those concepts were originally developed within the valuations professions of non-financial assets. So valuers, they have used this method long time ago, and we would then borrow that concept and use it in our way to measure non-financial asset at fair value. And within this concept, the emphasis here is the highest and best use must be for that asset must be physically possible, legally permissible, and financially feasible. Now, physical possible, that means you take into account the physical characteristics of assets, such as their location and size of a property. Now, this is quite similar to the emphasis of characteristics in fair value measurements, right? Remember, location, right? Location. And then legally permissible. Consider any legal restrictions on the use of assets, i.e., the zoning regulations applicable to a property. So again, this is one of the characteristics, restrictions within characteristics of the fair value measurements, right, such as restrictions. And finally, financially feasible, in that the market participant must be able to make a return from the asset from using the assets. All right. So in this case, we will look at the different alternatives that we can make use of these assets. Those are non-financial assets. Okay. And what we have to do is, under each of the alternatives, okay, that you may be able to use this asset, you in fact have to determine their market price first. Okay. And even after each of the alternative, right, each of the alternative of using it may have different principal or most advantageous markets, right? So you have to identify principal or most advantageous markets under each of the alternatives, and then identify their fair value. After that, you will pick the one which gives you the highest value, right, and determine the highest best use price for that asset. Okay, so that's the concept here. In fact, you are merging the concept of determining the principal and most advantageous market together with using this concept of highest and best use. So each of the alternative of using the asset, it determines their principal and most advantageous market, right? And then work out the fair value under each of the alternatives, and then choose the one which gives you the highest value. Okay, so that is in fact the essence of highest and best use price. Okay, let's look at an example then. So a donor gives a land to Dream Residents Association, DRA, a non-profit making company, specifying that the land must be used as a children's playground. And the DRA determines that this restriction would not be transferred to a purchaser if it sold the land. So if the land were not used as a playground, it could be sold to be used for residential development, achieving a selling price of 2 million. And if they were continuing using it as a playground, then the land could be sold for 800,000. So now what you have to do is determine the fair value of the land. Now there were two issues that we need to consider. Number one is the restrictions by the donor. And number two, how to use the land. Okay, so how many alternatives you can use the land. For the first issues, the donor restrictions is specific. Okay, restrictions of the land is in fact specific to the DRA only, and it will not be transferred to new purchasers of the land. And therefore, in this case, this so-called restriction can now be lifted, so you don't have to consider it. Then we determined the different alternatives that you have here. Obviously, there are two alternatives, as you can see from the question. Alternative one is use it for residential purpose. Second alternative is use it as a playground. Okay, so you have two alternatives. And then so happened in this case, you were given the fair value of each of these alternatives. So for the residential use, the selling price of the land is going to be 2 million. And if you use it for playground, then it will be 800K. And then, of course, we will pick the highest price, right? Highest and best use. So at the end, the fair value of this piece of land, should be 2 million. Okay, that's how you apply the approach highest and best use. So we're going to move on. So far, what you have learned is, in fact, you were given a fair value under different alternatives or even under different market situations. The fair value is provided. However, in some situations, the fair value may not be provided directly for you. You may have to work it out by yourself. Now, Hong Kong FRS 13 requires the use of a valuation technique that is appropriate in the circumstances and that maximize the use of relevant observable inputs and minimize the use of unobservable inputs. So in other words, to determine fair value, you need to have inputs. Inputs can be observable and unobservables. And then you have to pick the right valuation techniques that are deemed appropriate to determine the fair value. And when we try to use the valuation technique, we have to ensure that we pick the technique that maximizes the use of observable input and minimize the use of unobservable inputs. Observable input, you can consider that, like, for instance, it could be a market available data, and unobservable could be non-market available data. Okay, so what kinds of techniques that we were given under Hong Kong FRS 13? There were three. Number one, market technique. A valuation technique that uses the prices and other information generated by the market transactions involving identical or comparable assets, right? Liabilities, or a group of assets and liabilities such as business, or even in the case of ratio, price over equity. Oh, sorry, price over earnings ratios. Okay, so it would be like market-driven techniques. So you were using some valuation techniques, right, from identical or comparable assets, right, to work out your fair value. Of course, you need to make use of the input that were provided. Okay, input we will consider later on. The second method is cost method. In this method, basically, it reflects the amount that would be required currently to replace the surface capacity of an asset, such as instead of looking at exit price, now you're looking at like the entry price. What will be like if you want to buy them now in the market, right? Or you want to replace that item in the market. Okay, so cost, recurrent replacement cost. Or if you want to construct this item by yourself, right? That will be the cost. And finally, income valuation techniques. It converts future amount to a single amount. Okay, of course, you are trying to estimate how much cash inflow you can be earned by using this asset over a period of time and then discount them back. And the fair value measurement is determined on the basis of value indicated by current market expectations about those future amounts. So we use present value techniques. So three approach. The first one obviously would be relatively speaking better, but as per Hong Kong FRS 13, they in fact did not require the use of a specific valuation technique, nor does it provide a hierarchy of which techniques is best. However, in a given circumstances, it's accepted that one technique may be more appropriate than the other, and multiple valuation techniques may be used as well. So certain techniques are better suited to a particular circumstances. For instance, an income approach or income technique is better suited to a service industry, whereas a cost-based technique, right, may be better suited to a property company. It depends on circumstances, right? So that is basically the three techniques, and the standard did not specify which one is the best, okay, or which one is more preferable. It depends on situations. So in fact, the valuation techniques is all depending on, it is the judgment of a company to decide. But how about inputs? We'll talk about inputs later on, but before I start looking at the input, I have to make it clear whichever valuation technique is selected, it has to be used or applied consistently from one period to the others, and a change in the valuation technique would then be considered as a change in the estimate in accordance with Hong Kong AS8, which means that if you change your technique that affects the values, then the values would be adjusted prospectively. That means affecting future or current period. Okay, it's time to look at inputs now. There were three levels of hierarchies for the inputs that valuation techniques used to measure fair value. Notice that for valuation techniques, we don't have any preference which one is the best to be used to measure the fair value. However, for the inputs, we do have a kind of hierarchy here. Okay, and there were three levels. Level 1, quoted price, adjusted in active market situations for identical assets or liabilities that the reporting entity can assess at the measurement dates. Okay, so in other words, in this so-called level 1, we do expect that those items that we could inputs that we can use must be observable inputs, which I would define them later on. And then those are the input are extracted from active market for identical assets. Okay, for identical assets, that would be like an example which I will show you, like later on I will show you. But then let me give you one example first. So if you were trying to measure a fair value of a car, right, a certain model of a car, right, the best way to measure this input, this level of a car, this model of car, right, would then be, of course, to look at an identical asset that means identical car that would be offered at a certain price in the market, and that price would then be level 1. Okay, level 2, inputs other than quoted price included within level 1 that are observable data for assets or liability, either directly or indirectly, e.g. quoted price for similar asset, this time not identical, in an active market, or for identical or similar asset but not in an active market situations, or use a quoted interest rate for valuation purpose. Level 1 and level 2 is slightly different, as you can see, right? Sometimes those inputs could be quoted price or inputs that you can obtain within the market, but they are for similar assets in active market or for identical or similar assets within a non-active situations markets, or even just an interest rate to be used to measure your assets. Now, level 3 would be considered unobservable inputs for similar asset for assets or liability. In fact, in this case, you would use your own company's own assumption about the market exit value. So you would then use your in-house data, the company's own data, to measure the fair valued. Now, let's define the terms observable and unobservable input first before I give you an example. Observable are inputs that are developed using market data, such as publicly available information about actual results, events, or transactions, and reflect the assumptions that market participants would use when pricing the assets or liabilities, which is then, of course, different from unobservable. They are more in-house data. They are market data that are not available, that are developed using the best information available about the assumptions that market participants would use when pricing the assets or liabilities. So observable inputs can be obtained from any report that are publicly available for a listed company, but unobservable incomes could be in fact obtained from unlisted company, where the annual reports would provide such information for you to measure the fair value. Okay, observable, you may look at it as if it is marketable data, market available data, and unobservable would be in fact in-house data. Okay, now let me give you an example, and hopefully after this example you will understand what is the meaning, or what does it mean by level 1, 2, and 3 inputs. Let's talk about, let's say a company purchased a new model of foldable cell phone, okay, like a Huawei Mate X. Let's say they purchased 500 of them. All right, and now they want to measure the fair value of this foldable cell phone. What can they do? Well, it depends on what kind of input they have in order to determine the fair value, right? Now, if they can obtain, for instance, the current retail price of an identical cell phone in the market, then in fact that current retail price would be considered as level 1 input. For instance, Samsung Galaxy, they also have a foldable cell phone, right? And that would then be a relevant level 1 input. How about level 2 then? Well, if they can obtain current retail price of a similar model, notice that not identical to the Mate X, but similar model, then that would be considered as level 2. And finally, level 3 would then be based on what? The cost of productions of this cell phone they can obtain from maybe Huawei, and then add a plus, okay, profit margins to it. Then that becomes level 3. Okay, so level 1 and level 2, they were both observable inputs. Level 3, however, they are not really, okay, and you can see that how reliable the information will be, and obviously level 1 will be more preferable as compared to level 2 and 3. Now, to give you an overall approach here, how to make use of this, make use of the information you have to determine whether you have level 1, 2, or 3 inputs, I'm going to show you some input information now. This is a tree diagram here, a decision diagram. To begin with, right, let's start with the basic information then. We know that level 1 inputs are more observable and most reliable, and level 3, however, are unobservable and least reliable type of inputs. However, fair value hierarchy prioritized input to the valuation techniques, not the techniques themselves. Okay, so standard only requires you to choose the input which is most observable one. Okay, level 1 would be most preferable, right? And that's the hierarchy here. But in terms of the techniques itself, it's all up to you to choose, okay, to fit into the circumstances. Okay, let's start it with having a quoted price, okay, of the asset in the active market. Provided that quoted price does not require any adjustments, right? Then in fact, the quoted price will be considered as level 1 inputs, which is quite true, very easy. But let's say you have a quoted price, okay, and then you need to have adjustments. Okay, you need to have adjustments. And provided that adjustments right, for the quoted price does not involve significant unobservable inputs, does not involve it. No, that is why no. In that case, it is considered as a level 2 input. Now you still have to adjust it, okay, to fit into a specific asset that you are holding right now. Maybe because of the quoted price in the active market does not fully represent the asset that you will purchase. Okay, and in this case, you may need to make some adjustment for it, and that adjustments does not involve significant unobservable inputs. Therefore, level 2 inputs. Okay. Now, then let's go back to the first blue box here. You do not have a quoted price in an active market. No. Okay. So it's unlikely that you will have level 1 inputs anyway. But your inputs are still considered to be observable, like level 2. Okay. And this time, right, if you does not require any significant unobservable inputs for adjustments, then of course it would be level 2 as expected. But if in the case that your input is not observable, so that it is likely that you will have level 3 inputs, right, because they were unobservable, right, then it would be level 3. Now let's go back to here where we do not have quoted price, but we have observable inputs, which is like level 2 in theory. And this time, because you need to have adjustments, and that adjustments involving significant unobservable inputs, then this originally believed to be a level 2 inputs will now becomes level 3 inputs. Okay, so I hope this chart here would help you to understand the concept. So if this is quoted price, in theory should be level 1. Observable inputs, which means level 2 instead of level 1, because level 1 would be having most reliable and most observable inputs, then it's likely to be level 2. If it is not observable, level 3. However, we need to take into considerations possible adjustments as well. If it does not require adjustments, of course, level 1. If it does, and if it does not involving significant unobservable input, it becomes level 3. But if it does involving significant unobservable inputs, right, then even though originally it looks like a level 1, it will become level 3. Okay, for level 2 input to begin with, if it does not involving significant unobservable inputs for as adjustments, then of course level 2. If it does, level 3. All right, so if an observable input requires adjustment using unobservable input, and that adjustment considered to be significant, higher or lower fair value measurements results, the resulting measurements would then be level 3. Okay, let me give you 2 examples to go through the concepts. Okay, so the first example here, it doesn't require you much understanding in terms of analyzing the info. In fact, we give you the facts. For an asset, like if you have a shares in a listed company, all right, then level 1 input is likely to be the unadjusted quoted price in the active market, which is true, right, because you don't need to be adjusted. And for assets such as cash generating unit that you have learned from I1, remember when you do the impairments test for company where in fact not every assets can generate future cash flows for you, then you have to group them up into cash generating units, right? That variable valuations multiple, like multiple of earnings or revenue or similar performance measure, derived from observable market data, then obviously that would be considered as level 2 inputs. In the third case, where you have a building held and used, the price per square meter for the derived from the observable market, again involving comparable building in the similar location, then it will be level 2. Now level 3, again, it is still the example of cash generating units, but this time you don't have input from outside, but instead you were building up a financial forecast but using your own company data, so they are unobservable data, then it will be level 3. trademark as well. The expected royalty rate that could be obtained by allowing other entities to use the trademark to produce the products covered by the trademark, and those rates would be internally developed. That would be level 3 as well. Let's look at a second example. The example is requirement. What level are the inputs used in determining the fair value of the equity investment in FIT-FAS company? And what is the overall categories of the fair value measurements of these equity investments? So let's look at the questions. The fair value of an equity investment in an unlisted health company called FIT-FAS is determined based upon the company's earnings before interest, tax, depreciation, and amortization, EBITDA in short, multiplied by the published PE ratio, price-earning ratios applicable to quoted companies in the health company, fitness sector, adjusted for lack of marketability. So in other words, the question is asking for, okay, when we were trying to determine the level of inputs for the overall that equity investment, we may have to consider each of the components that we would use to determine the overall. So for each of the components, you also have to determine the level of inputs. And we know that there are two components. First component is in fact the P ratio. But that P ratio is in fact applicable to a quoted companies within the same sector. In principle, should be level 1. But because FIT-FAS is an unquoted company, so we have to adjust it for lack of the marketability. So that means we have to adjust the quoted price for the unobservable inputs. All right. Then let's look at the second possible components, which is the EBITDA. The EBITDA of a FIT-FAS is in fact a level 2 input. They are in fact observable inputs from an unlisted company that can be obtained from the markets. Okay, from the markets. And therefore, in this case, by combining the two, it would be considered as level 3 measurements. All right, so this is a case where you have to look at individual components to determine the overall level of inputs. Okay, let's take a break then.